Okay, so very good morning to you. Today, the topic that we shall be discussing is swaps. It's a very interesting topic, and um, it's a very risky topic as well, because in the 2007 crisis, which was largely ignited by the banking failure, swaps were considered to be one of those culprits which ignited the whole problem, and which was acting like a catalyst, like it was something making the crisis faster than it could have been in the absence of swaps. But swaps are definitely one of the very widely used instrument for hedging, and we'll discuss it as we proceed. These are the topic objectives about the swaps. So we will study how the multinational companies use the swaps for exchanging for the foreign exchange and the interest rate movement. Swaps can be used by many ways, but in this topic, in this course, we shall restrict our discussion to the extent of the borrowing and the exchange rate movement. So this is something we need to keep in mind. And how these financial intermediaries, they play a role. They play a very big role in the swaps. I mean, the banks, these financial intermediaries, they play a big role in it. Swaps are over-the-counter OTC contract, which means it's not it's very much negotiable. It's not something which you can buy in the market. So by nature, swap look more like forwards, where you can negotiate the terms, conditions, all the specificities, specific rate of exchange, and all that stuff. You can decide beforehand by meeting the bank official. So, but the problem is that the swap is not having any secondary market where you can sell the instrument. Okay, so that is something we need to keep in mind. Swaps are very widely used instrument. This data is old. I can tell you the more current data. Swaps trading on daily basis is a massive amount, at least $50 billion a day. The first topic, the first part of swap that we discuss today is called interest rate swap. Remember, when you borrow, the two things. When I borrow money from the bank, I borrow the amount, certain X amount. So after some time, I need to pay back that amount back to the bank. But on top of that, I'm also supposed to pay the interest rate. So try to understand, when I take a loan, my cash inflow is once, but my cash outflow is on multiple times. So basically, my cash flow is not only on multiple times because I pay a part of my debt on yearly or 6 monthly basis. But more importantly, my cash outflow by nature is of two types. First, I am paying back a part of the principal amount which I borrowed. And the second part is the interest on the loan which I am also paying. So my cash outflow could be decomposed into two parts: the return of the principal amount and the interest payments. Interestingly, the name of the first kind of swap is called interest rate swap. It doesn't say the principal swap. It says interest rate swap. So basically, if I'm entering the swap market and I swap my borrowing with somebody else, then I will not pay for the borrowing of yours. I will only pay for the interest rate of yours. So my responsibility to make a payment is not included to the amount of the principal, but my responsibility to pay is always restricted to the interest rate. And this makes sense also because let's study the concept of swap. Swap is what? Swap is that one company can borrow. Generally, we have a choice to borrow at the fixed rate or at the floating rate whenever you borrow from the bank, because I've been through many times this kind of process. The bank is always offering you two types of borrowing scheme. The one is the fixed interest rate, and the second is the floating interest rate. And the idea of the fixed and the floating is that imagine I want to borrow at a fixed rate, and I have a reasoning for it. My reasoning is that if I borrow at a fixed rate, then I know for sure that I will not pay interest more than the fixed rate. And if in the future the rate of interest goes up, and if I borrow at the floating rate, it means that my interest rate payment will go up. Try to understand. If today I fix a deal with the bank that I want to borrow for the next 30 years, but at a fixed rate, and let's say the fixed rate is 3%, I know for sure that for the many years to come, my interest rate would be 3%. And why I want to fix myself to 3%? Because I have a doubt, I have a hunch that if in the future the rate of interest is on the rising side, 4%, 5%, 6%, and if I borrow on the floating rate, my cash outflow would be totally, they will make my company bankrupt. So let's say I have a natural choice, I have a natural interest to borrow at the fixed rate. And then we have one more person, some other company, some other borrower. That person wants to borrow at the floating rate. And what is the reasoning of that person to borrow at the floating rate? That person is thinking that in the future, the interest rate will go down. So why should he or she borrow at a fixed rate when the interest rate is going down? So we have a different perceptions. I want to have a fixed rate of interest of borrowing because I'm afraid of the interest rate going up, and I have a strong reasoning to make some kind of projection that the interest rate in the future will be rising. And the other person have a strong reasoning to fix his borrowing at the floating rate because he or she thinks that the interest rate might go down in the future. So why should that person should fix himself to the fixed rate of interest? So we have a difference of perceptions, but we don't know each other. We don't know each other. Okay, so what happens? My original borrowing will be in the fixed rate of interest, the fixed borrowing, the fixed rate of interest borrowing. And that person borrowing would be the floating rate borrowing. Neither I know him nor he knows me. We're just strangers. After some time, now there is a anticlimax in the story. After some time, I start repenting that, hey, why did I borrow at the fixed rate? I think I would have been much better off had I borrowed at the floating rate. It means it's like making a bad choice, something that, hey, I have something I'm not happy with, and I'm happy with something which I don't have, but I want to have it. So I have fixed rate borrowing. I want to make it floating rate borrowing. The other person who borrowed at the floating rate also have an element of unhappiness in life. The life is full of these kind of situations. That person who borrowed at the floating rate is now repenting that why he didn't borrow at the fixed rate. So I have fixed, I want to convert to floating. He has floating, he wants to convert at the fixed. We don't know each other. We don't stand in the street with the placards that, hey, I have this, can somebody swap? Then comes the market system. Look, this then comes the market system. This example seems to be in the old economy, the barter economy, when people were swapping goods for goods. But that was a very complicated story. And the beauty of the market system was that the buyer and seller don't need to know anybody. We can just swap our things with the help of the price mechanism. So price mechanism has brought a big thing, and it has totally got rid of those limitations of the barter system. Same way. I don't have to wait until somebody accidentally bump into me who wants to convert his floating to fixed, and I want to convert my fixed to floating, right? So we know where to go. Where we go? We go to the bank. And the bank facilitates our swap banking. Maybe it's the same bank. Maybe both me and the other company, other person, we borrowed from the same bank. And now we want to be the beneficiary of the swap arrangement. And maybe now we go to the same bank again, because the bank which we borrowed from is dealing with the swap arrangements. So everything seems to be in control. And then what happens in the swap bank? That I would explain with the help of the example. But my point here is that mark in the bold letters that this interest rate swap is only restricted to the interest rate. My original borrowing remains intact. And this is also very logical, because I borrowed at fixed, I want to borrow at floating now. That other guy, he borrowed on the floating and he wants to borrow at the fixed. So we have some element of compatibility. We can do some exchange, but try to understand, I borrowed a different amount and he borrowed a different amount. It's a very coincidental that we borrow the same amount. So what we do, if we borrow the same amount, it's okay, but which is just an exception. Most likely we would have borrowed different amounts of the original debt. So therefore, it will be unfair if I borrow more and he pays me more amount. And it will be unfair to him if he borrows less and I pays him less. So that is why the original amount of borrowing is not considered at all. We only are responsible for the interest rate swap. And this is why, but we need some amount to make some calculation. That fictitious amount, that hypothetical amount where we kind of agree that, all right, it could be possible that my original borrowing is 200,000 euros and the other person, his original borrowing is 150,000 euros. And the bank agreed that, okay, let's make all the calculation on 100,000. That's the base amount on which we make all the calculations, okay? So we make all the calculation on, let's say, on 100,000. That amount, you might have heard this word in your presentation. That amount is called notional amount, hypothetical amount, imaginary amount. And we have no choice but to imagine, because in the real life, we are borrowing different amounts. If swap was also including the return of the original borrowing, then the other party would pay 200,000 of my debt and I would pay 150,000 of the other debt. I would be favored, and the other party would be unfavored. This is unfair. So that is why we don't consider the original amount of borrowing, and we only keep calculation on certain common base amount, which is called notional amount. And I pay the other person's interest liability, and the other person pays my interest liability. So this swap is only restricted to the interest rate liabilities, not the original principal amount. That is not included. I wrote here, not principal amounts. And ironically or sarcastically, we call the interest rate swap as the plain vanilla swap. The reason we use the word plain vanilla is that, hey, we only pay for the interest, and that is a vanilla, nothing else. So that is why we use this word plain vanilla swap as a term for interest rate swap. So this is some background, or this is some understanding, the basic understanding of the swap. And I wrote here also the exchange of interest payment only. That's it. The underlying notional principle is never exchanged, just for the calculation, nothing more. And this is for the normally for the long-term borrowing. I mean, if the company is borrowing for 10 years, 20 years, then the swap can come in action. Okay, but if your company is not having long-term debt, but you rely more on the short-term debt, then I don't think so it's a good instrument, because it's like a very committed kind of instrument. So you rather use options or the forwards instead of anything else, or just borrow the normal amount. Okay, if you borrow the short-term borrowing, then the time of repentance of your bad decision is less. So, but if you have a long-term borrowing and you are repenting, then there has to be some solution. Okay, and the solution is the interest rate swap. Okay, let's take an example. Assume that the two companies, A and B, and let's say by chance their principal amount is 100 million for each, and for the same time period, 5 years. But even though I would go a little bit more, that even in the example, if I say that A borrows 200 million and B borrows 300 million, but the notional amount is 100 million, that still solves the story, because in the real life, the companies borrow a different amount. But the bank, if it wants to bring two parties together in the swap arrangement, they have to have a common base of borrowing, and that is called notional amount. Okay, so in this example, I made things simplified, but even if I say that the 100 million is a notional amount, it's perfectly fine. A is a triple B company, as you can see here, counterparty A, triple B. Triple B mean it's have a least credibility in the market, and it's not a very well-known company. I mean, many companies would prefer not to even have any business dealings with this. So the credit worthiness of this company is very low. On the contrary, B is a triple A company, the safest company in the world. Okay, now because B company is AAA, therefore, the bank will offer it low rate of interest when it comes to fixed rate. Look, B is offered 7%, whereas A is offered 8.5%. It's very obvious. Why? Because here, for the A company, the risk premium is huge for the bank. Bank is taking a huge risk to give money to A company. So therefore, it is charging more amount of interest, what we call as a risk premium here. Whereas B could be as safe as anything, So the B is paying less rate of interest when it comes to fixed rate. But even in the floating rate, B can borrow at 6 months LIBOR or LIBOR. LIBOR is London interbank borrowing rate, which basically means that this is the rate of interest at which the safest company in the world can borrow. And because it's in the initial is L, which stands for London, it means that this is determined by all the multinational banks based in London. Okay, but now after this euro was formed, when we had this ECB, in the eurozone we use Euribor, which basically means, which is same as LIBOR or Euribor, or that is a European interbank borrowing official rate, something like this. This is the full form. But the basic purpose is that Euribor or LIBOR is the rate of interest which the safest companies would pay. No risk premium, no threat. But as you move away from AAA, as you leave your A's and start getting B's, AAB, ABB, or triple B, what happens? Look, the risk premiums start coming in the picture. So in the floating market, if B borrows 100 million, it would only pay LIBOR. But if A borrows, it has to not only pay 6 months LIBOR, 6 months mean this is for the 6 months, basically. But it also has to pay the 0.5%, the premium, risk premium. 6 months mean the interest rate would be revised after 6 months. So, Now, if you see, we have a principle of comparative cost advantage in the international trade theory. The principle of comparative cost advantage says that if I'm efficient in both products, let's say there are two countries, country X and country Y, and there are two products, A and B. Country X can make both products A and B. Country Y can make both products A and B. But country X is more resourceful, there's more labor force, there's more trained labor force, everything is very favorable. On the contrary, country B has poor technology, not country B, country Y, sorry. Country Y has poor technology, the labor force is horrible, things are not very good there. In country X, the cost of producing both goods A and B would be low. In country Y, the cost of producing both goods A and B would be high. Does it mean that country X should produce both goods and country Y should not produce any good? If that is the case, then no foreign trade would take place because country X is basically producing both goods and country Y is producing is not producing anything. So what should country X sell to Y, and what would country Y would give back to country X? The foreign trade will not take place. So in one country, there'll be total shortage of goods. In the other countries, there is total surplus of goods. In one country, there is a problem of shortage. In the other country, there is a problem of plenty. In one country, things are not available, people are dying of starvation. In the other country, the food is rotting and nobody is eating. Both cases are not good. Both situations are not good. That theory is called principle of absolute cost advantage. Now, in this example, we are also studying some economics as well. That theory is called absolute cost advantage. But then we have a theory called comparative cost advantage. Comparative cost advantage says that, okay, fine, X has an advantage in producing both A and B, and Y has an absolute disadvantage in producing A and B. Now, wait a second. Out of A and B, find out where X has more advantage and where X has less advantage. So X has advantage, of course. For both countries, for both products A and B, find out where X has more advantage and where X has less advantage comparatively. And choose that product to be manufactured by country X, where it has more advantage. Come to country Y. Country Y has disadvantage in producing both A and B. I repeat, country Y has disadvantage in producing both A and B. Find out where country B has less disadvantage. In one product, either A or B, country Y would be having more disadvantage. Whereas in the other product, country Y would be having less disadvantage. Let country Y produce the product where it has less disadvantage. And let country X produce that product where it has more advantage. Now, one product is produced by country X, the other product is produced by country Y. And what will happen? Now, when they do the trading, both countries would be happy. Country X will not have too much of surplus. Country Y will not have too much of shortage. That theory is called theory of comparative cost advantage. This theory I studied a lot when I was doing my studies in economics. The same argument is produced here. If you look at the best company in the world, B, and the most horrible company in the world, A has comparative advantage, absolute advantage in both. Look at B, fixed rate 7%, floating rate LIBOR. Look at company A, fixed rate 8.5, 1.5% more. Floating rate LIBOR plus 0.5, 0.5% more. If I look at the absolute, not comparative, if I look at the absolute cost advantage, then B is a great company in both fixed and floating. And by that rationale, A is the horrible company in both fixed and floating. So the bank should not give any loan to the A company altogether. But that's a problem. How can bank only focus on its lendings to certain companies? So the bank is offering too much of lending to certain companies and bank is not offering any lending to certain companies. The corporate system doesn't work like this. We have to give loan, we have to give credit to the banks or to the companies, all types of. Of course, we can charge more interest from them. Cover your risk. The banks can cover risk. How the bank is covering the risk? The bank is charging 1.5% more from the bad company. Bank here is charging 0.4% more from the bad company. Well, I don't want to demean it, but I'm just trying to make it simple. Good company and the bad company. The good is B, the bad is A. But when you look at the comparative cost advantage, you find that here, company B, the good company, has 1.5% more advantage over the bad company A. Here, the company B, the good company, has 0.5% more advantage than the bad company A. In other words, the company B has more advantage when you compare 1.5% advantage and 0.5%. Comparatively, company B has more advantage in fixed borrowing than in floating, 3 times more. Now look at the point of view of company A, the bad company. The bad company has 1.5% disadvantage. 1.5% disadvantage in the borrowing of the fixed rate. The bad company A has 0.5% disadvantage in the borrowing of the floating rate, of the flexible rate of the, yeah. In other words, the comparative cost advantage principle says that the original borrowing of company B should be in fixed rate, because that is where company B, the good company, has more comparative advantage. 3 times more advantage. 1.5 is 3 times of 0.5. Company A, the bad company, has absolutely disadvantage in both. 1.5, but 0.5. But in floating, its disadvantage is 3 times less than it would be in the fixed rate borrowing. It means the original borrowing of the bad company A should be the floating rate borrowing. This is the first premise of the swap. That in this example, it's not an absolute rule, but as per this example, the good company B has a 3 times comparative advantage in terms of fixed rate over floating rate. The bad company A has 3 times disadvantage less disadvantage in floating borrowing in comparison to the fixed rate borrowing. So our initial point is that B should borrow at fixed and A should borrow at floating. If you see the vertical difference, the fixed rate, only focus on the fixed rate column. This vertical difference between the fixed, the company A, this vertical difference of the fixed rate, when the base is fixed rate and we are comparing company A and B, this is 1.5%. Positive, positive, negative doesn't matter, because if B is above and A is below, this will be minus 1.5, but that doesn't make any difference. Sign doesn't matter. This difference is 1.5%. When it comes to the floating rate difference between company A and company B, this is 6 months LIBOR, this is 6 months LIBOR, so cancel. 0.5 is left. Positive. If this 6 months LIBOR was on top and this 6 month LIBOR plus 0.5 was at the bottom, it would have been negative. So it doesn't matter. Positive difference or negative difference, it doesn't matter as long as you are consistent. Look at the horizontal difference. If I see the horizontal difference, 1.5% minus 0.5%, this comes to be 1%. I hope you agree with me, 1% difference. Coming back to one of your questions, if this horizontal difference is non-zero, then swap would be benefiting both counterparties, as well as it will bring some commission to the bank also. So everybody would be happy. But the condition of this happiness is that this difference, horizontal, this minus this or this minus, doesn't matter. Positive, negative, doesn't matter. If this difference is non-zero, mark my word, non-zero, then swap can lessen the burden of both companies A and B. But imagine, this is 1.5, just imagine. And this vertical difference is also 1.5, and 1.5 minus 1.5 is 0. Then there is no use of swap. No use of swap at all. Swap is only useful if this horizontal difference is non-zero. Positive, negative, small, big, doesn't matter. But if both are 1.5 or both are 0.5, imagine this is 7 and this is 7.5, not 8.5, 7.5. Then this would be 0.5 difference. And this is 0.5. 0.5 minus 0.5 is 0. Swap is useless. Swap is only useful, and this usefulness will not be to one company or to the second company alone or to the first company alone, but this will also include the bank. Which bank? Which is facilitating this swap arrangement. So 3 institutions would be the beneficiary of this swap arrangement, but the condition is that, the theoretical condition is that if this horizontal difference is non-zero. Horizontal means this difference. This minus this is non-zero, which is in this case is 1%. This is called quality spread or effective spread. Effective spread is 1%. In this example, effective spread is 1%. It basically means that there is some 1% existing. I hope you understand why I'm saying it 1%, because 1.5% minus 0.5% is 1%. 1%. Sometime in the banking jargons, in the banking business jargon, it's very difficult to use percent time and again. So 1% is considered to be 100 basis point or 100 BP. So instead of saying half percent, 0.5%, they say 50 BP, 50 base point. Okay, so try to understand that 1% in the banking business language is basically called basis point or BP. Okay? I wrote here 0.5 is 50 basis point, 1.5 is 150 basis point, and the difference is 1%, which means 100 basis points. So there's a 1%. Basically, this 1% shows that there is some 1% existing, which nobody is taking any advantage of. And if we do the swap arrangement, bank will earn commission out of 1%, and both counterparties A and B would also lower the cost of their borrowing. But altogether benefit available to 3 institutions, 1 bank and 2 companies, will not be more than 1%. So 1% is the maximum limit of the benefit which 3 organizations / institutions can grab through the swap arrangement. Okay. This 1% is also an indication theoretically that the markets are not working perfectly, because if the markets are working perfectly, if the markets are perfectly competitive, no market imperfections, the way we studied in economics in the first semester, if the markets are perfectly competitive, there's no problem in the markets at all, everything is great, then this horizontal difference would always be 0. But the fact that in this example, this is a non-zero, it means that it shows a sign of imperfections of the markets, which is realistic. The markets can be close to perfection, but no market can claim to be perfectly competitive. Okay, so this is this 1% is a bonanza, which all 3 organizations would be sharing. Okay. Yeah. So this is I clarified here. Sorry, I just disappeared for a second. Okay. Now, you must remember in your mind that there is a 1% bonanza, the bonus available, which to be shared between 3 parties, 2 counterparties and 1 banking institution. And how they do this spread, how they divide. There's no rule, first of all. There's no formula. There's no formula at all. There's no theory. How this 1% would be shared between the bank and the 2 counterparties. It's all mutual. It's all mutual negotiable. And in the exam, not in the exam, but in the assignment, I think you'll be told how this benefit would be distributed between 2 counterparties and 1 banking institution. Okay. For example, there is a 1% benefit available Um, and let's say, let's say that, sorry, if you allow me for it. So in this example, there's no rule, as I said, there's no theory. I just haphazardly or randomly, I shared 1% of benefit between three parties. The bad company A, I decided, well, I just decided, there's no theory, that it would get 0.65% advantage of 1%. 1% minus 0.65% is 0.35%. Okay. And the company B, the good company, would get 0.25 advantage, 25 basis point. And out of 0.35, if I subtract 0.25, the rest is 0.10%. This 0.10% would be the advantage which go to the bank. So bank would be getting 0.10% advantage. But how we reach this figure, this is something we need to work out. So I repeat, there's no theory, because see, this is a over-the-counter contract. So this is negotiable. There's no market mechanism in this case. Okay, this is negotiable, and the negotiation takes place that, okay, bank would decide, okay, this would be share of this advantage to this party, and this is my commission. This is the way they decide. And the way it's decided in this example, the way it is decided that 65 basis point, which is 0.65, advantage would go to the bad company, A. 0.25% advantage will go to the good company B, and the difference is 0.10%. This would be given, this would be taken by the bank as its own commission, or whatever you can call it. Okay, I hope it's fine, yeah? And now we come back to the calculation. And this part is very, it needs your attention. If you want, I can give you 5-minute break. Take a 5-minute break and come back, and then we discuss this part. This part is the most important slide of swap arrangement. If you get happy with this, everything great. So I want you to get the fresh mind. Go and grab some coffee, as I did myself. So come back and we resume in 10 minutes. So take a short break. All right. Once again, I think I need to repeat that how they are splitting the advantage of swap, which in this case is 1%. We saw it. 1% is the horizontal difference. That is advantage. There's no theory about it. It's all negotiable. It all depends who has the bargaining strength. The one who had got more bargaining strength. Like, for example, when you can negotiate. So if you are good at negotiation, if your negotiation power is more, all right, you get more advantage. And if you are not showing any interest, or if your negotiation power is weaker, maybe you don't get the fair deal. So it's based on that. And in the assignment, this how the advantage is split, hopefully is mentioned. If not mentioned, then you assume that all the three parties share the whatever benefit available equally. That is something you can assume. If I forget to write down how the advantage is shared, maybe wait a sec. I think all right, so we move on. So we decided, we found out that 1% is the effective spread, the advantage, and 0.65 would go to the bad company A, 0.25 would go to the good company B, and the rest 0.10% would be the benefit which would be taken by the bank. All right. The most important slide. A borrow in floating. Left side is the reality, right side is your wish. Keep in mind, left side is reality. Left side of the equation is reality, and the right side is your wishes. We agreed in the beginning that the bad company, would borrow at floating. But what happens after some time? A company, the bad company, realized that, hey, you know what? I made a bad choice by having the floating borrowing. I think it was good for me to borrow at the fixed rate. Life is full of we revise our decisions, we relook our decision, we reassess our decisions. Like in life, in any aspect of life, we can also reassess our decisions in the financial life as well. According to comparative cost advantage theory, the bad company should borrow at the floating rate. But in reality, A is repenting of its decision. It says, I think floating is not good for me. I think fixed would have been good for me. But the problem is that if the bad company borrows in the free market, in the open market at the fixed rate, look at the cost. 8.5% is huge. But see what happens in the swap. In the swap, the bad company can borrow at 7.85%. In the non-swap arrangement, mark my word, non-swap arrangement, in the normal banking system, the bad company, if it wants to borrow at the fixed rate, it has to pay 8.5%. Look, the bad company, triple B company. Triple B means very bad company, actually. 8.5%. But in the swap arrangement, this company can get 7.85%. And you know where it comes from? Wait a sec. It come from 8.5%, the original borrowing rate to A. And how much is the advantage going to be out of this 1% spread? 0.65%. Do you remember this? There is a 1% horizontal difference, and 0.65% advantage will go to the bad company A. And this is what we decided. How we decided, we don't know, but it was mutually decided that this advantage, 0.65 or 65 BP, would go to company A. Maybe A has better negotiation skills. And when you subtract it, it comes to be 5, 4, 14, 6, 8, and then 7. So under the swap arrangement, A borrows at floating, A wishes to be at fixed. But if it goes directly to the normal banking system, it would be paying 8.50%. But if A chooses the swap path, it can take 7.85% because bank is giving it 0.65% advantage. This is the basic arithmetic. Resume it. So it means this is the reality, and this bank can get. Now, company A is paying floating, and company A, the bad one, is paying floating already, and now company A would also pay fixed, 7.85%. But this is unfair. How can you pay fixed and floating back? The bank says, hey, wait a sec. You are paying me floating. I return your floating, but only to the extent of LIBOR, because LIBOR, why LIBOR? Because this LIBOR, the bank is getting from company B. Remember, company B is paying a LIBOR, can pay a LIBOR to the bank. So what bank does? The bank says, you are paying me floating, I pay you back floating. So floating cancels with the floating. And this is something which you must pay me. And the difference is what you pay me. So I repeat, I actually explained this with the help of the whiteboard. The bank says to the company A that, hey, originally you are paying me LIBOR plus 0.50. And your total cost should be 7. What was 8.5 minus 0.65? Let me go to the previous one. It was 7.85. So your total fixed cost should be 7.85. This is what you are paying me now. This is what you want to pay. But I can't charge both from you. You don't want to pay floating, so I pay you back floating, so the floating and floating gets the cancelled. But whatever difference exists, you pay me so that your total cost is 7.85. So what happens then? Now you have to use a bit of mathematical equation. LIBOR gets cancelled with LIBOR. 0.5% is there. What should be added to 0.5 or 0.50? The total is 7.85. What should be added to 0.50 so that total is 7.8? So the arrangement is that this is what originally A is paying. This is what bank A can borrow, the fixed rate, with the advantage of swap, share of split of the advantage, whatever, we discussed it before. But bank says that you will not pay me floating and fixed together. That will be unfair. So bank says to the A company, you pay me floating, I pay the floating back to you. So floating cancels. So you only pay me fixed. Question is, how much fixed? The total cost of fixed is 7.85. Floating cancels. But in the floating, there is 0.50% fixed component here. So basically, I'm asking you a simple mathematical question that what should I add in 0.50? So the total is 7.85. And as you said, it will be 7.35%. And that's what comes here. Okay, so what happens that your total cost is 7.85. So you pay floating, you get floating back from the bank, and then you pay 7.35 additional to make it 7.85. It's like saying that I bought a shirt, I bought a cardigan for 50 euros. I bought it, I'm not happy with it. I go to the bank, I go to the shop and I say that, hey, I'm not happy with this cardigan. Can I return it? The shopkeeper says, yes, of course. But would you like to buy something else? I say, I want to buy that cardigan. And that cost me 80 euros. So I will not pay 80 euros. I will pay for the difference. So what I do, I take my jacket off, cardigan, I give them back. I pay additional 30 euros and I get that new cardigan. Simple. That's what I've done here. You have floating, you return it, you get the floating back, and then you pay something more, difference, and get the fixed. As simple as that. So this is the idea. This is how bank is treating the company A, the bad company. Now let's see how the bank is trading the company B. And again, I take you to the calculation so that we know what we are doing. So I'll come back to it when we finally calculate. But first of all, I take you to the whiteboard. Okay. Now see what happens to the B company, the good company. The good company was paying in fixed. And the fixed it was paying was actually 7%. I hope you remember. But it want to, this is the reality. And this is the wish. The wish of the good company is that it could borrow at the floating rate. In the normal banking arrangement, I repeat, in the normal banking arrangement, if this company B goes to the normal bank and it wants to borrow at the floating rate, if you see the original question statement, it was 7%. So it was 7%. That's why I wrote 7% here. And if it wants to borrow at the floating rate, it would pay LIBOR. But this LIBOR is only valid if the bank, if this company B is borrowing in the normal. I hope when I say normal, it means that if the, I hope you still remember the slide where I gave the full question that if company B, the good company, which is AAA, if it borrows at the floating rate, it has to pay the LIBOR. But what is the advantage of swap? The advantage of swap is that we agreed that after 0.65% is taken by A company, 0.25 would be taken by company B. So it means the right side of the equation would be LIBOR minus 0.25%. LIBOR, B can borrow in the normal relations. But out of this 1% of this effective spread, 1%, 0.65% has been taken by company A, the bad one, and 0.25 would be taken by company B, the good one. So because if LIBOR is a normal rate, then it would be even cheaper by 0.25% than LIBOR. So this is what bank would, the company B, the good one, would get in the swap arrangement. Okay, so this is what you do, what you pay in fixed, and this is what you will pay in the floating. But you can't pay both. The bank says that I give you, you pay fixed, I pay you back 7.25%, more than what you pay. But you pay me the difference. And the difference is, please tell me, what should I add here in these numbers that my right-hand side of the equation is LIBOR minus 0.25%. B, the good company, is paying 7% fixed. The bank gives it back 7.25%. But you pay the difference so that the right-hand side is equal to LIBOR minus 0.25%. See the beauty. See the beauty of swap. Bank is getting 7.35% from A, giving 7.25% to B, and the difference is 0.10%, bank earns the commission. B could get floating at LIBOR. But now B is getting even 0.25% cheaper. And A, which was the bad company, was getting the fixed rate borrowing at 8.5%. Now it gets at 7.85. Everybody's happy. Bank gets 7.35 from A, gives 7.25% to B, and take 0.10% advantage. A gives LIBOR to the bank. A gives, the bank is giving LIBOR to the bank, to this company A, and then it is getting LIBOR from B. B gives floating, A gets floating. A gives 7.35%, B gets back 7.25%. So it's a basic numerical example, basic calculation. And if you look at this table, you will see how it works. From A, the bad company, the bank receives 7.35%, but bank is paying him a LIBOR. For B, the good company, LIBOR and happens then. LIBOR gets cancelled, and bank is getting 7.35 minus 7.25, 10% commission. So all happy. B gives LIBOR, A gets LIBOR. So bank gets floating rate from somebody and pass on the floating rate to somebody else. A pays 7.35% to the bank, and bank in turn pays 7.25% to B and keeps 0.10% with itself. All happy. 1% has been split between A, B, and the bank. And that's a swap. So there's a 1% anomaly. I use the phrase anomaly. There's some 1% imperfection. It's like arbitrage, the riskless profit is available. And bank is not only because bank can't borrow from itself. So it needs some companies to borrow. Then it gives a proposal to company A, to company B, and they agree, all right. So A continue to pay its the floating rate borrowing. B continue, A continue to keep its floating rate original borrowing. B continue to keep its fixed rate borrowing, but when it comes to the interest rate, B is paying, the floating rate. B's borrowing is fixed, but the interest it pays is floating. A's original borrowing is floating, but A is paying fixed rate. So nothing changes with the original borrowing. The only thing changes is that you are paying different interest rate. The one who borrows at the fixed rate borrowing is paying floating interest. And the one who borrows at the floating rate borrowing is paying the fixed interest. This is making a big difference in the cost. Look at this. Look at this A company. Goodness gracious me, 8.5% rate in the original borrowing, and now it's 7.85%. Look, this is what you have, this is what you wish. Not only that your wish is fulfilled, but your wish is also fulfilled much cheaper. That's the beauty of swap. So not only your wish is fulfilled, in the normal circumstances, company A was even willing to pay 8.5% to fulfill its wish to have a fixed rate of interest. But now it pays 7.85%. So wish is fulfilled and even cheaper. Similarly, B wanted at floating. It's very, it's very angry at its fixed. In the normal circumstances, it would pay a LIBOR. But see, it's paying less than LIBOR, even 0.25%. So your wish is fulfilled and also much, much, much cheaper. And even the bank is not doing any charity. Bank is also getting the 10%, 0.10%, 10 BP. So all happy. It's like a win-win-win situation for three organizations. This is the concept of the currency swap. Here the choice is not between fixed and floating. Here the choice is between the exchange rate. And fixed floating now we don't bring in the discussion, that's done. If you bring it here, it will complicate your understanding. Here, I have the old-fashioned example that there's a Finnish company headquartered in Finland, but has its operations in the US. It needs dollars because it needs to pay salaries, it needs to buy raw material, employ people from Los Angeles, wherever, make some local expenses. If it borrows in dollars, it's expensive for it because, of course, it's a non-American company and there's always some kind of interest rate disadvantage. On the contrary, there is also an American company in Finland. And for the same reasons, it needs euros. But if it borrow from the European bank, or let's say more specifically from some Finnish bank, Nordea, it will be paying more interest. Okay, so here, the Finnish bank, the Finnish company would borrow in Finland, not in America. The American company would borrow in America, but not in Finland. And then they are exchanging, swapping their borrowings. But very important thing you keep in mind. This is not a plain vanilla swap. So you not only swap the interest rate liabilities, but you also swap the principal amount. So basically, the Finnish company would borrow from the Finnish bank the whole amount and would transfer to the American company. American company would borrow from the American bank the entire amount and would transfer to the Finnish bank. So here, not only interest rate are swapped, but the original borrowing is also swapped. So basically, I can say that I pay for, living in Finland, I pay for the amount borrowed by the American partner and also the interest rate which he pays. And my American partner is paying for the borrowing which I made in euros and also the interest rate which I pay in euros. But the only arrangement is that if you borrow in your original the original currency, it's much cheaper. So that is the whole thing. So let's take an example. So here, remember, two counterparties exchange the principal plus the interest obligation. So it's not a plain money. And this characteristic differentiate the currency swap from the interest rate swap. In the interest rate swap that we just discussed, there's only interest rate exchange. But in this currency swap, the full amount is swapped. And once again, we bring in the discussion the notional amount, the common amount, because if American company is 5 times bigger than a Finnish company and they borrow 5 times more, that doesn't mean that the Finnish company has to pay 5 times more, the principal amount and the interest. All the calculation are done on a notional. Notional means which is fair amount, common for both parties. So that is something we need to keep in mind. Okay, so fixed or whatever, doesn't matter. Yeah, that's not a problem. So what happened? X is a US-based company. It wants to hedge its euro exposure because it has work in euro zone, and it invests 200 million in the euro zone. Why is a French company and it has to hedge its US dollars exposure of 200 million, and let's say that the exchange rate is dollar is more valuable. That to get $220 million, the French company needs to spend 220 million euros because at this rate of exchange. The US company can borrow at 7.5% in America. But if US company borrows in Eurozone, it has to pay 8.25%. Oh, that's huge. And the French company, if it borrows in wait a sec, interest 7. Yeah. So yes. So we can assume. All right. So when it comes to the dollar borrowing, the US company pays less. The French company pays more. For obvious reason, because French company is a non-US company, so it pays more interest. Whereas if you want to borrow in the euro loan, the US company would pay more and the French company would pay less for the very obvious reasons, because French company is part of euro and American company is not. So that's why American company pays more. So what happened is that instead of US company borrow at this rate, and the French company borrows at this rate, the US company, even though it needs money to be invested in Eurozone, it borrows at this rate from the American bank. And the French company, though it needs money in the American, in the US, but it keep borrowing in the French Eurozone. So instead of American company borrowings at this rate, and instead of the European company borrowing at this rate, this is a foreign rate of exchange for American company, and this is the foreign this is the foreign borrowing rate of interest for the American company, and this is the foreign borrowing rate for the French company. Instead of this, the American company borrows in dollars in the domestic debt market. The French company borrows at 8.1%, which is a domestic debt market of the French company. So the borrowings, even though needed across the border, are done in the original countries. And then what happens? The US company borrows 200 million from the US bank, and the French company borrows 220. Remember, 220 because the rate of exchange was $1 equal to 1.1 euros. So to make it equal notional amount, if US company borrows for 200 million, then the French company borrows at 220 million from the French bank. Okay, and then these dollars are transferred by the US based company to the French company. Remember, all this dealing is done through the banking system. So it's not just like the exchange between company to company, but there is a financial intermediary involved in it. But anyway, the French company gets $200 million, and the US company gets 220 million euros. And then what happens? On the dollar borrowing, the domestic rate of interest was 7.5%. 7.5% means $15 million. Who is using this money? 200 million. This 200 million amount is borrowed by the American company, but who's using it? The French company. Therefore, this interest would also be paid by the French company. Obviously, the one who used should pay, because the dollar borrowing is taken by the American company but given to the French company. So French company should pay it back. Not only $200 million, but also the rate of interest. On the contrary, the American company is using 220 million. And the rate of interest on 220 million is 8.1%. This is the annual cost of interest payments. And who's using the euro borrowing? The American company. And who should pay the interest? Obviously, the American company. So each year, the French company is paying $15 million to the US company. And each year, the US company is paying 17.82 million euros to the French company. So you are not only, you're also taking care of each other's interest. And then finally, when the period is over, loan period is over, American company would return its euros. American company would return 220 million euros back to the French company, and the French company would return $200 million back to the US, and the game over. But the beauty of this arrangement is that American company, if it wants to borrow in euros, would pay 8.25%. But now on behalf of US company, the French company is borrowing at 8.1%. Thus, the US company is saving its cost of borrowing for the European operations. And for the US operations, if the French company was to borrow from America, it would pay 7.7%. But now it pays only 7.5%. And the French company is saving 0.20%. Everybody happy. But the only difference you keep in mind is that in the currency swap, you not only pay the interest rate of each other. So $15 million interest paid by the French company, 17.82 million interest in euro borrowing, but paid by the American company. So you not only pay each other's interest cost, but you also return the original amount. And how much was the original amount? 200 million borrowed by the American bank, but given to the French company. 200 million borrowed by the American company, but given to the French company. 220 million borrowed by the French company, but given to the American bank. But now it has to come back. French company would return 200 million to the US company, and the US company would return 220 millions to the French company, and game over. So this is how the currency swap works. Calculations are much simple, but the concept is a little bit complicated because you not only pay the interest cost, but also you pay the original amount of borrowing. And that's end of the swap section.